What makes a good investment? Hey everyone, Luke here, Tax, Tech and Tactics. Today I'm going to be delving into the question of what makes a good investment. Now, before we delve into this, let me just give you a bit of background. So, when I am working with clients, most of what I do from a CFO perspective and a business advisor perspective is all focusing on how businesses are going out and raising an investment. So I spend most of my time actually sitting on the other side. But obviously, business just is fascinating to me in all aspects. So I spend a lot of time looking at businesses, business opportunities, investment opportunities for myself, family, friends, and clients as well. So this video was sparked by a question from a client this week where they were asking me to have a quick look for them and decide whether this investment was good for them going forward. It was a early stage SaaS platform, so something obviously I'm very familiar with. And it just really got me thinking about what is the process that I go through before we decide whether an investment is a good decision or not. And I'm not talking about the formal due diligence, so a big disclaimer here. This video is talking high level, right? High level, does this pass the sniff test? As in, does it smell like a good investment to me? Then, if it does, then obviously we go and do all the background work. We hire all the professionals, legal, financial, all the rest of it to do full due diligence and all the rest of it. So, big disclaimer, you cannot make a definitive decision based on this alone, but it does get you in the right frame of mind. So I asked myself 4 questions. That is it. Is this a good business? Is this a deal at the right price? Will it give me big enough returns? And is it right for me right now? So that's it. 4 simple questions, which obviously invoke a ton of other questions. But let's just delve into the areas of each of these 4. So first of all, starting off with what I presume is an obvious starting place for most, but is this a good business? Fundamentally, is it a good business? Forget the investment opportunity itself. Is it a good business? Are its prospects good? So the very first question I look for, well, actually, let me rewind. Before I ask any questions, obviously, you're going to go and do a little bit of due diligence yourself. You're going to have a little look around, website, company's house, check out who it is. The pitch deck is probably the starting point that comes over. See if you can see any clients they've got, maybe reach out to some of those. But so you do a little bit of sort of background work, but then I start asking the questions. And so the first question I ask for is, what's the current financial position of this business? And to do that, I'm going to need to see some data, some management accounts. Now, I get all kinds of stuff thrown at me here. A big part of what we do working with clients is to produce good quality management accounts, but not everyone has those. So one of the first things is, do they even have management accounts, or are they clearly scrambling around to put these together? If they are, it's a big red flag for me. If they do have them, are they actually any good? Do they give me enough information? Do they look accurate? And that's a hard question to answer at first glance, but and can they articulately explain the story behind those to me? So I appreciate that, especially if you go early stage, these founders or people that we're talking to probably not going to be finance trained, but they still need to have a good grasp on their business. So some big red flags there potentially for me. But otherwise, then I'm looking at historically, what have they done? So what's their revenue profit like? What's the journey to get to this stage look like? Factoring things like COVID and other things in there as well. How strong is their current balance sheet? And what's their cash flow position look like? Is it positive, negative? Are they in desperate need of investment because their cash is really low? Or actually, is this the stage to take to go to the next journey? Once I've satisfied myself with the existing position, and obviously, just a quick caveat there, if they're really early stage, i.e. pre-revenue, then there's probably not going to be a whole lot of information in there. Sometimes you're just looking at like what they've spent money on so far. So it's still all informing part of the decision, but how important a part of that decision depends on the stage of the business. Then, which argumentally, this is probably one of the biggest questions here, but does the model work? Fundamentally, does the model work? And I'm not talking about the spreadsheet model they've sent over to you, or they may or may not have, but does the model of the business work? So have they clearly thought through how they're going to make money? I know it sounds crazy, but particularly early stage and tech are very guilty of this sometimes. They get caught up in the concept and they don't yet know how they're going to monetize that or turn that into money. So do they know how they're going to make money? Can I see a pathway to adding other revenue lines in? Are they, if they're loss making already, is there a pathway that I believe in that will turn them profitable? So there's some of the first questions that I ask when I look at it straight away. And then the next is, does the business scale? Because if you're investing in a business, you're hedging your bets that this business is going to grow. So it needs to show a pathway to scalability. So knowing what I know, looking at a model, what are the bottlenecks? What are the common bottlenecks that business is going to come up against? And have they thought about these? Are they aware of them, and how are they going to potentially tackle them? So a big one is can they keep acquiring clients at the rate they are, or the rate they're forecast to if they're pre-revenue? And importantly, how much is it going to cost to get those clients? So with flex testing, the CAC, the client acquisition cost here, is a big part of making a decision on this. And what happens if I stress test other areas of the model? Like, how much flexibility is there in this? So what I mean by this is, well, what happens if costs are bigger? What happens if the launch date is pushed back 6 months? What happens if we don't achieve these sales and we achieve 25% less for a whole host of different reasons? Does it still stack up, and is it still a model that works that I can play with? If it does, great. But then the ultimate question is, do I think this model is realistic and achievable? Because with the right skill set, anyone can create a model that can answer most of those questions. But in most cases, it can be completely fabricated. So do I then believe that model that works is achievable, and we can go out and work on that as a team? So once I've done that, the next part of, or the final two bits of the model for me is playing around with the total addressable market. So looking at TAM, how big is it? Do they know how big it is, or have they just plucked a figure out of 5 seconds research online, and they're just giving you some huge 5 billion market, and we're going to get 30% of it kind of approach? Or are they actually thought about how they're going to go out to that market, what segments they're going to go after first, how they're going to access those, and is that realistic, and does it also give enough scope in line with their growth plans? So in other words, are their growth plans going to exceed what's realistically achievable from their TAM in a short period of time? And then finally, does their cash flow part of their forecasting hold up? So is the burn rate realistic, as in how quickly are they going to get through that cash, or are they being over optimistic? How well do I think they're going to manage the cash, which goes on to the next point quite a lot. And really importantly, is this enough money? So if they're asking for a certain amount of money, is it enough to get them through successfully to the next fundraise or the exit, depending on where they are? But for early stages, it's probably going to be the next fundraise. Aren't they asking for enough money? If they don't ask for enough money, and you're going to have to go and do an emergency fundraise, that's going to be terrible for everyone. So the next part is, again, in early stages, probably the fundamental question that people are going to ask themselves from an investor perspective. But do you believe in the team? Do I believe that this team is capable of doing what they say they're going to do? That's vital, right? So if it's really early stage, all you've got is a concept and idea that anyone can buy into, and then you're betting on the team to execute and deliver that. So do they have experience previously in other businesses? Have they done this before? Have they fundraised before? Have they exited before? Great. I'm not saying you have to have all these, but these are the questions we ask. What skill sets do they have? So obviously, from my perspective, I'm looking for some finance skill set in this team here. It might not be in the founder team itself, but in the wider team around it. Are they well supported to plug those skill gaps they don't have? So if the founders aren't finance trained, then who is going to help them manage that finance well? Are they going to spend the money that we give them well? If not, that's a big red flag. If you're a tech or SaaS business and you haven't got CTOs or CTO type experience embedded at the founder team, then you're probably going to have a problem there from my perspective as well. So another red flag. And then finally, for the model, what's the competition like? So who else is out there? What are they doing? And why do you think you're going to be better than them? Now, founders have an amazingly warped view of this question. So still ask the question, but they either typically believe that there's no real competition out there when you ask them, because they're so different to everyone else. or that their product service is 100 times better and it's going to be easy. They just need to get out to market and get the awareness out there, and then everyone's going to come flooding in. Now, it's good to see a founder with that level of belief, and if they don't have that level of belief, it's probably a bit more of a worry. But actually, I, as a making an investment decision, have to take those rose-tinted glasses off and ask some hard questions here. So what's the moat like? What protection have you got against others once you go out to market and people see what you're doing? Is there any IP here? For anyone that just says it's their brand and they're really early stage, that's a big worry for me, because it's incredibly hard to do that. So once I've analysed the business as a whole, I'm going, yeah, look, this is a good business. Fundamentally, this is good. They've got some good prospects here. I like this. I like this business. The next question I'm going to ask myself is it the right price? Because it could very easily be the right business at the wrong price, which still makes it the wrong investment. So I'm looking at how much they're asking for, and I'm looking at their company valuation. I do tons of content on how to value businesses, and frankly, there are so many different ways. Every business is different. Every industry is different. The earlier stage it is, the more guesswork it is. It's just a fact. There's very little facts to go on if you're pre-revenue. And ultimately, although a bit of a cliche, a business is only really worth what someone is willing to pay for it. So what I mean is that every type of investor or every type of buyer, if you're looking at an exit for a business, they have different criteria, which you're about to see in the next two questions, but different criteria about how they approach and value a business. And therefore, a business is truly worth something different to most people. So we've got to ask the question. So my starting point for this is always to the founder: how did you come up with this valuation? Because I want to see that they've thought it through. It's not plucked out of thin air, and I want to see what their thought process is. Now, it's not to say I'm going to necessarily go with that and go, yeah, okay, I'm definitely going to agree with that. Now you said it, but it's important to see that first of all, before I make my own decisions about this. I then want to factor in the stage they're at. So what does the next part of the journey look like? As in, are they going to need to go out and raise more money again? If so, what amount are they thinking they're going to raise, and what sort of valuation? And how does that dilute my shares here? Because that changes the price that I'm willing to pay at this moment in time. So, and then the final part is that a lot of this valuation will be based on the model, the forecasted figures. So how much, again, asking this question myself again, but how much do I believe that this model and these forecasts are realistic and achievable? Because if I don't fully buy into them, and their valuation is based on a multiple of profit, for example, a multiple of revenue based on the forecast I think they're going to achieve, then I have to say, well, what if I don't think they're going to achieve those figures, and scale it down a bit? And then the other part to that is, well, what if the multiplier? Because let's be honest, there's tons of different ways to value businesses, but most of them are done on a multiplier of revenue or profit. For simplicity, it's hard to negotiate around investment and sales on other factors. So, do I believe in those forecasts and models, etc.? But then also, is that multiplier the right sort of multiplier? So, going out and looking at other people in the market that have raised that are similar potentially, or just what I feel is right. So is it the right price? The third question now moves you into a whole different ball game. The first two questions are all about the business. Is the business good business? Is it the right price? So the investment. That's arguably the same for any investor that's looking at it. They will have different criteria, but essentially most people should come to the same conclusion around if it's a good investment. The valuation bit might fluctuate, I get that. But the next two questions I ask myself about an investment are purely to do with me. And this is where every investor is kind of approaching this from a different perspective. So number 3, will it give you a large enough return? So you can see why this is all about me, because that question is very much dependent on what I'm looking for. And that's the key to it. So before I ask any questions here, I have to get clear on what my investment strategy is. What time frame am I happy to invest over? What's my risk tolerance? How risky am I prepared to go here? What return could I get elsewhere in something safer? So whenever I'm investing in a business, I have to think about, well, actually, could I invest that money somewhere else that's a lot safer? Because any investment in sort of early stage businesses or even late stage businesses is a risky type of investment. That's why the returns have to be so potentially high. And then fundamentally, if you're a business owner yourself as well, the really important question you should be asking yourself is this money that I'm about to invest better spent investing in myself, my own business? Because it can be really easy to do the sort of shiny new object syndrome, or chasing the money. Your business is doing well, you're starting to make good money, you've got a bit of spare cash, and people are telling you to go and invest in other businesses. Well, that's fine, but only once you've absolutely maxed out your own sort of investment capability, and putting that money back into your own business or keeping it in your own business isn't going to generate you more returns. So ask yourself that first of all. Once I'm happy with kind of my outlook on what I'm looking for investment, then you need to play around with the route to exit. So does it have a clear pathway for me to exit my investment? And again, depends on what stage you're entering at. So the exit could be the next investment round. If you're really early stage, the next investment round might be institutional investors, a fund coming in, and the plan might be for that fund to buy out the smaller investors, the angel investors. You might be okay with that. You might not. Might want to stay for the journey. It might be that the exit is a full business sale. So the founders would have typically thought about that. You want to know who they're potentially going to sell to, when they're potentially going to sell, and what price they think they can achieve. Again, that will be based on the forecast. So the model has to work for you. If in 5 years they're going to get to 10 million in revenue, and the standard in your industry is a 10x multiplied to revenue, then you can sort of say, arguably, if they do what they think they can do, then 100 million is on the table. But what does that look like to you? So by that point, you might have been diluted because other shareholders might have come in. So how does that look in terms of dilution? So there's a lot of questions here to ask yourself. If the founders are not clear on how you're going to exit, then run a mile. Because in these sort of investments, and unless they get all the way to IPO, which is extremely unlikely, statistically speaking, so there's not an obvious way for you to exit this investment. So you need to be clear, and they need to be clear, the founders, on how that this potentially going to work. I say potentially because there's absolutely no guarantee here. There's so many factors that are outside your control, even potentially some that are outside the control of the business, the wider economy, global pandemics, wars, and stuff like that. So you don't quite know what that's going to do to the markets 3 or 5 years out, and you can't necessarily predict that. But you can weigh up your own expectations of what you think is possible. And again, like everything, stress test this. So what happens if actually you only achieve 50% of that valuation that they think they're going to go for? So instead of 100 million, it's going to be 50 million. Does that still give you a decent return? Are you happy with that? What if they say it's going to take 3 years, you think it's going to take 5 or 6 years? Again, over the 5 or 6 years, does that investment return give you enough? What happens if you're diluted? What happens if they run out of cash early and they need to do another investment raise at a lower valuation, a down round? What does that do to your dilution? And then does it still potentially give you enough return on investment? And you can then start to, once you've got answers some of those questions, you can then start to balance those against the risk factors that you think are involved in this decision. So this is where things like SEIS and EIS really help early stage investors, because the tax incentives, if it goes wrong, are really, really great here. So that automatically reduces the risk. If it goes to zero, then at least I'm still going to get 40% of my money back, or whatever it is, depending on how you set those schemes up and how much you've invested. And then the final question that I ask myself is the one that most people miss. So by this point, you have decided that it's a good business, the price being asked is sensible, and that you're happy with the potential returns. So most people are going to dive straight in now. But there's one final question you have to ask yourself. Is it right for you right now? So it could pass all of those criteria. It could be a great investment. But is it right for you right now? So what I mean by that is, do you actually have the money to invest? That sounds like an obvious question, but like I said on the last point, is this money better used elsewhere? Is it going to cause you problems by doing this? Are you at risk of falling foul of FOMO? Are you scared of missing out because you think it's a great once-in-a-lifetime opportunity? I guarantee you it's not a once-in-a-lifetime opportunity. There's so few of those around, but it can be really easy to get caught up on this. So I implore patience here. And just because it's the right investment, you have to ask yourself if it's right for you. So some of the other things as well, for me personally, that I'm going to ask, some of the other questions are, does this really excite me? Like, it might be a good investment, it might make good money, but does it excite me? Does that matter? Some people it doesn't matter to, but do I like the story, the concept? Do I buy into it? Is it an area I'm familiar with? So obviously a lot of tech and all the rest of that will play up to my sort of strengths personally. Yeah. If it's an investment in an area that I don't know anything about, then how comfortable am I with that? Again, some people are fine with that, but to a lot of people, you want to be familiar with the area. When they give you updates on the company, you want to understand it. And does it match my values, social and economic impact, all of that kind of stuff? Because if you have strong values and this company is grating against those, then that might be more important than just purely making the money. It should be to most people. So to wrap up this video, a quick recap of the disclaimer at the front, because it's so important. All the questions I've posed in this video are just to get me to that high level, yes, I like the idea of the investment. It's absolutely not the final part of making that investment decision. Yes, it's the good business, the right price, big enough returns. It's right for me right now. Great. Now I will go into the full process, which I'm not going to cover in this video, which is the due diligence process. So hiring, the legals, the financial due diligence, checking out everything I've been told, and all the rest of it. You can't skip that stage. Okay, so this video is not investment advice. There's no place of doing that. It's so important that you do that. But it should get you in the right frame of mind for starting to analyze opportunities. The more you're involved in this world, the more opportunities that will come your way. So you start to create your own process. Part of me doing this video and writing this newsletter was actually to document my process, because I was asked about it from a friend. I said, what do I look for in a business? And whilst I do lots of sitting the other side of the table and saying to founders, think about your investor, actually to be put on the spot and asked about my process, it was quite interesting, because I clearly did have a process because I do this regularly, but I hadn't ever articulated or written it down. So that's it. Keep it simple to start with, and then dig deeper into each of the areas that have concerns. So the 4 main questions: is it a good business? Is it the right price? 2 that are personal to you is, will it give me a big enough returns? And finally, is it right for me right now? If you're a founder watching this video, then ask yourself these questions in relation to your own business. If you're an investor and you ask these questions to yourself as the founding team, how would you answer them? That's going to strongly help you make sure that you have answers to the right questions, your model's right, your pitch deck's right, and the preparation going into investment raise are really good and strong as well.